The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending Friday the 13th, 2020 of March. Well, coronavirus. All right, we got that out of the way. Oh, let's talk stocks to start with. The World Stock Index was at the test of long-term support. The MSCI All Country World Shares was down 15% on by Thursday of this week. We got a bounce on Friday. As I am making this video, foreign stocks broke support, and things are not looking good in the world of stocks. The S&P 500 tested the 2018 low, and as I said a moment ago, we did get a rally on Friday up, I think it was over 1,000 points, so I'd have to check the exact numbers. And the SPOOS, the SPX, was also nearing long-term support as of Thursday. Big sell-offs in the markets. I'm not telling you anything you don't know, but we're hitting a major uptrend line drawn from the 2009 bottom and touching the bottoms of late 2011, excuse me, and the low in 2016, and also that huge sell-off in December of last year, running up that as a trend line. We're basically testing that level, and so far have come up off of it. My long-term perspective is that this is just the beginning. I think we're going to see much lower values on the stock markets overall, but it will ebb back and forth. Overall, I think we're trending down. And one word of caution is that it's like the old saying about the generals are always fighting the last war. Investors are always investing in the last bull market. So there'll be a lot of people that will be talking about the greatness of the stocks and hold for the long term, and this is a buying opportunity and all that, when actually a paradigm shift has taken place. Gold, as I've said for years, is the most negatively correlated asset to the stock market, not gold stocks. They sympathize with the stock market generally on big sell-offs because they are stocks. Gold has been up and down during this sell-off for a couple of reasons. One is that most of the big money managers hold a gold position. Secondly, central banks hold gold, and the central banks are the most in trouble. If we know what's going on in the repo market, we don't know exactly every detail, but we know in a general way they are in deep trouble. They are looking for like 500 billion or half a trillion here, half a trillion there, and a half a trillion again. So we are looking at insolvency in the banking system, but no one likes to say that word, I will, which means they may have had to sell gold to get it into dollars to make a settlement with another bank, insurance company, pension fund, the Fed, who knows. So that's also part of the reason. Another reason is that a lot of the bigger retail dealers and maybe even some of the wholesalers actually lease gold, not in the traditional lease paradigm that most of you are aware of, but with more like an Monex situation where you might deposit 20 contracts worth of gold with a big wholesaler such as A-Mark, and they're a public company, so you can look this up. And with that pledge or that great collateral, what's better collateral than gold or silver, they use that to leverage cash, and they use that cash in other ways. And then if, like any margin call or any leverage position, if the equity, the collateral falls below a certain level, then A-Mark would call up the party and say, send me some more cash, or we're going to liquidate your metal. And sometimes the metal does get liquidated. It certainly happens, and it's not that rare in these type of events where you have these major sell-offs. So there's some pressure. Lastly, the silver market has hit an all-time record, or pretty close to it. I know it's been to the 100-to-1 ratio. I think this is the third time I'd have to look. It's a pretty rare event. I think it got to 104, and usually that's on a spike. Generally, what happens in the metals market is that the market spikes, and the 100-to-1 ratio is a very clear indicator of a financial crisis. So that ratio is telling us financial crisis, and it looks like we're certainly in one. We're certainly in a bear market, at least by traditional methodologies, meaning a 20% decline. Is it going to go further down or not? I would say it is, but the market knows more than anyone. So just some headlines. We're going to go pretty quick here. The 5 biggest tech companies lost more than $400 billion of value on Thursday. Of course, I'm doing this on Friday, and some of that came back up today. But gives you the idea that Apple, Facebook, Alphabet, Amazon, and Microsoft combined $416 billion to the downside on Thursday. Mish Shedlock from Mish Talk, 75% of companies suffer from coronavirus supply chain disruptions. And this you can read. It's a good one, but basically all you need is one part that's critical to the completion of whatever, an automobile, a phone, a piece of machinery, a washing machine, doesn't really matter. You get the idea, and that causes a disruption. So even though China is responsible for about 28% of global manufacturing, the impact is this. Pretty frightening, actually. I think one of the most important markets always, and I don't talk about it every week, is, of course, the oil market or the energy markets, which is primarily oil, obviously, gas as well, but oil. From London, from Reuters, the world's top rating agency said on Tuesday, that's this week, of the sharp drop in oil prices, if sustained, could cause a wave of sovereign downgrades as well as heavy multi-notch rating cuts to junk-rated oil and gas firms. Fracking, it's done. I think it's done. I mean, there's a few I think that at 30 might eke out break even or maybe some kind of a profit, but that's probably creative accounting from my perspective. So there's a lot going on, this oil war, you might call it, basically the annihilation of the petrodollar. I mean, this is really, really big news. I'm not going to comment too much on it because I need to see a little more to kind of wrap my head around what's really going on, but it looks like a bit of a fight between the Saudis and the Russians, and of course America's left out from the aspect. I mean, it's hurting badly, but Russia and Saudi can produce oil a lot cheaper than the United States can. Energy independence, yeah, at $60 oil, but at 30, you might want to rethink that. So everyone wants that hedge, and what is it when things go down? What's your hedge? And usually it's gold. Gold's usually the best. A lot of the crypto fans are, well, crypto. Well, they did worse than the silver market. I mean, you look here, and I'm not trying to pick on cryptos, I'm just reporting facts here, but you look at Bitcoin down 40%. This is on the 12th. Ethereum's off almost 44%. Bitcoin Cash off half, 50%. EOS off about 50%. Teos off 47.75%. I think you get the idea. It's there's not a lot of safe harbors right now. Cash, of course, would be one. Just a quick look here at the deficit spending. It's global. And I'll just hone in on the U.S. U.S. government posted a $235 billion budget deficit in February. And that's before this corona really got going. It was going pretty strong in February. Anyway, look, $235 billion a month times 12 months. You're looking at round numbers, maybe $2.5 trillion for a year. So, people are upset with a $1 trillion a year deficit under the Obama administration. You might be looking at 2.5 times that. And this is really before the real ramp up that I just mentioned a minute ago with the Federal Reserve basically willing to put in $1.5 trillion. There's been different numbers floated around. Sounds to me like it's about $1.5 trillion into the repo market over the next few weeks to bring stability, quote unquote, stability into the repo market. Interesting times, folks. You really got to wake up. I think anyone that listens to this channel and others like it are probably pretty well awake, but you might want to just check your premises on what you think's really going on. Look at the worst case scenario. I'm not trying to be the big boom, doom, doomer. What I am saying is think it through for yourself. You got too much money in cash in the bank, which is actually a safe harbor, but what if, the bail-in takes place? Best cash you can own. I wouldn't even say in moderation under these conditions, 20% is probably about the right amount, but it's a case-by-case basis. Regardless, the point is, we are facing an area that really is unprecedented, and because of that, you need to really think out probably several weeks, especially if this situation under this virus deal becomes more threatening as far as what you're able to do. able to travel, able to go to work, able to attend meetings, whatever. I'm not forecasting that, but certainly I am very familiar with trends, and it looks like that is the trend. So you might want to think that through a bit for you and your family and make some quick determinations of what are the essentials that you need if you're required to stay in place for a given amount of time. Okay, I'm just going to spend the rest of my time on the silver market and try to give some perspective to what's going on here. I know a lot of silver investors follow me, and there's some that have given up, and that's fine. It's true of all markets. Regardless, we've taken a pretty long look at silver market. I basically called the breakout at 555. It actually happened in 2003 and took off here. And we had several years of an up market, got up to 21, and then we had the financial crisis. And we came down here from 21 down to a little below 9, I guess. I'll call it 9. And from 9, we started actually the best bull market we've seen so far in years. So from that bottom, that crisis bottom, we went all the way up to nearly 50 on a spike. I called that high. Thought it'd last a couple years. Was completely wrong as far as how long it took. And we came down here. We basically, from a long-term perspective, been trading between the $14 level here and you might call it the $20 level here, which is a pretty big spread, but you can just look at it. You're here at 14, you're up to 20, you're here at 14, you're up to 20, you're coming down toward 14 as I'm doing this video. So what I want to do is take a little more of a zoom in here on the 2008 crisis, what it looked like, and then I'm going to come over here where we are right now and do a comparison. Okay, I've got this in a scale. I think it's easier to see. You can see that silver in the July time frame was up here around the $20 level. And then as this financial crisis took effect on everything, gold included, it really hammered silver. So it went from roughly this level where my cursor is all the way down to here, which was 10.5. And we got some pretty big buying right there and got what I'll call a relief rally. So we went from the 10.5 level up to about 13.5. And then that's as far as it went. And it started down again to get to the final bottom, which is down here. So I want you to keep that in mind as I go through where we are right now. And let's look at the time frame. This first bottom, I'll call it at 1050, took place about middle September. And then the middle of October, it was back at that level. And then going into November is when we actually hit the bottom. We stayed at the bottom, this level around the $9 level, from basically the end of October, all of November, half of December. So I'll call that a month and a half. I had on this half month. So about 2 months where it was bottoming. You know, the exact bottom is right here, my cursor is, and that was a 1 day event, but that didn't just pop right back up the next day. It stayed at this level for a while. So you can see here, we stayed here for quite some time, and this is the bottom tick according to this chart. So be prepared. Now, once we got there, we started back up gently, got back up to this 1350 level here at this time, and if you keep going, you'll see that the market continued up. So I want you to think about that, and again, I'm going to go to where we are now and maybe get some perspective. Remember, markets don't necessarily ring exactly, but they do tend to forecast future events, especially when they're similar in nature, meaning that we're doing this during a quote-unquote crisis. Okay, so here we are at current day. I'm doing this at the end of the day on Friday, as I said, as I announced this. So, you know, we were here not very long ago, 18, almost 19, and then the big sell-off, and any silver investor knows that. We were down at this level. So based on what I just showed you, what I want you to bear in mind is we'll probably get a relief rally. And where will it go? I don't know. We'll just call it there just for talking purposes. Then we might get another bottom. It might not be that one. This could be it. I don't know. It certainly seems like it, and we'll talk about that in a moment. And then we will probably start back up. Now, this is just conjecture. No one knows. It could just hit here and it could come up faster. In fact, I'm inclined to think it will come up faster. But it won't be a week. It won't be 2 weeks. It'll probably be, in my view, probably take a month or two before we go. It just depends on the market itself. The similarities between now and 2008. In 2008, the market ran out of silver retail product. Not silver, but silver that the average investor buys, which would be the minted coins from the U.S. Mint and other government mints. That's taking place again. You can't, the spreads on Silver Eagles is humongous, even for the dealers, the wholesalers, like $3, when they're normally like $2.25 at the most. So basically, the U.S. Mint is out of Silver Eagles. The Canadian Mint is out of silver Maples. The spread on any product, even 100-ounce bars, is widening, which means that there is physical silver buying. I know this for a fact because of my relationship with a lot of the wholesalers and main retailers that most of you know by name. So as in the last crisis of 2008, the sell-off took place a bit after, and the silver market, silver investors seized the opportunity to buy silver physically at that place. A couple more comments. Number one, the palladium market really got creamed today. It's been falling off, and there's margin calls all over the place for the palladium futures players. And most of the players in the metals usually have multiple positions, not only multiple contracts, but they have metals positions in gold, silver, platinum, and palladium. Now, not all of them have all four. A lot of them might have gold and platinum or palladium and silver or whatever. The point being is that margin calls were going crazy, and this added to the selling pressure. Secondly, the large places like A-Mark that I described earlier give out loans. That could be part of the problem. The last one, which I think I already mentioned, is that central banks have gold holdings and they can sell that. So a lot of pressure on the gold market for a variety of different reasons, pushing the price down. Gold held above the 1550 level as of yesterday. On Friday, it broke through. It's still above 1500. I still feel strongly that gold's doing its job. I mean, it took 6 years to get to 1350. That was a 6-year high, breaking out to a 6-year high. All of that's behind us as long as gold remains above that point. I'm pretty certain that it will. It's going to take gold to move. And a lot of people ask me this question, and I'll close out. Why doesn't a big investor buy silver? And this is a bit embarrassing, but I'll just tell the story in a general way. There was a group out of the Middle East that wanted to take some protective cover relative to their cash position. And I embarrassingly said, why don't you buy some silver? And they basically laughed at me, which they had every right to do, because it would have taken 0.5% of the kind of money that they were trying to protect to buy up the entire silver market. And they said, well, okay, we'll buy up the silver market. Now what do we do? And I think that's something to bear in mind, everyone. One, it illustrates that the silver market is extremely small. Two, it also illustrates with so many trillions of money, capital floating around, where can it hide? And it can hide in the gold market, because the gold market is a much bigger market than the silver market. But it doesn't negate the fact that silver is actually probably one of the best places. The problem is that there aren't any really big players that are willing to do it. The last one that we know of substance was Warren Buffett, and he hasn't mentioned the word silver since probably 2010 or something. So I don't think there's going to be any nation state running to the silver market. I don't think there may be some, relatively small hedge funds that move into the silver market, but it's going to be the people. And the people are usually behind the curve. Not always, though. I mean, I'm kind of double talking on both sides of my mouth, and I don't mean to. I mean, a lot of people, regular people, are buying this dip or this, decline right now, and I think they'll continue to buy. And the other part is there's delays already. So similar again to 2008, you can't, hopefully don't panic. The reality is it's pretty tough to get silver right now in size in the physical form. And the paper markets always set the price until they don't. And the palladium market is a perfect example. And that's just an industrial commodity. That's not really a monetary metal. So the last time that silver had this crisis, once it established that bottom after 2 months or so, as I showed you, it made that bull run and went from basically 9 up to 50. So that's history. Remember, I've said for years that 90% of the move comes in the last 10% of the time. And the fact is that in January 1979, silver was $6 an ounce. And January 1980, silver was $50 an ounce. It went up 800% in a year. I'm not saying that silver's going up 800% from right now. What I'm trying to let you know is that I don't think this bull market's over, although the sentiment is certainly looks like it's over, but I don't think it is, and time will tell. I'll leave you with that. Take a deep breath. Don't panic. There's more important things on the planet than money, although money is important, and telling the truth is the most powerful thing you can do anytime, anywhere. Be respectful of each other, and I'll be back with you next week. Hello, I'm David Morgan, publisher of the Morgan Report, and as some of you may already know, the Morgan Report is about money, metals, and mining. In fact, we cover all resources, from rare earth elements to precious metals. I've been publishing on the internet for about 20 years. My primary passion is to help people build and preserve their wealth. I love to make people millionaires. I've helped thousands of people via our research in the Morgan Report, which has thousands of paid members and 10 times that amount on our free weekly updates. Here's what you'll receive from our free newsletter. To-the-point webinars, weekly analysis of the financial markets, interviews and our conference schedule, special reports such as riches and resources, and various metals price forecasts. Our paid service client base is primarily small to medium-sized business owners, professionals in the industry, or the seasoned investor who understands markets and the value of precious metals. My area of expertise includes equity analysis throughout the resource sector, energy metals, base metals. We cover startups to billion-dollar corporations. We focus on a special sector that makes money regardless of price oscillations, and the importance of precious metals due to the ongoing currency devaluations. Our team of 3 analysts and support staff can help you build and protect your wealth. It's important for you to know what other people have said. We're passionate about what we do. High integrity and trust. Tell the truth and own it. If we're wrong, we admit it. Take a long-term outlook with major assets, and bet a little to win a lot with speculative situations. If you choose to become a client, you will gain financial insights very few, even professionals, recognize. You'll understand the importance of honesty in our financial system. You will understand how the money system influences almost everything in your life. You'll be prepared for the ongoing currency crisis. And finally, I've chosen to make my life's mission greater than the individual, which means my mission statement is to teach and empower people to understand the benefits of an honest monetary and financial system. It's been a great journey so far, and the best gains in this sector lie ahead over the next 3 to 5 years. I'm fortunate to have earned the status of being a leading authority in my field in helping others protect their wealth. You can email me at support@themorganreport.com or call my office at 480-325-0230.